And so what's going to happen is you're going to see prices incrementally move up year over year to compensate for the hike in wages that we've seen around the globe. But it is something we have to monitor, and I think you have to expect that if interest rates are going to remain elevated, then home prices probably have 20 to 30% downside from their highs. And I do absolutely think that this is one of the things the Fed needed to pop these bubbles. Now, the question is, can the Fed control the collapse?
In today's video, Chief Market Strategist of InTheMoneyStocks.com Gareth Soloway tells us all about his latest analysis of the charts as well as his predictions and price targets for Bitcoin. According to Soloway, Bitcoin may face a lot of uncertainties in the near term as a result of the ongoing global economic declines, and we can still possibly see the Bitcoin price drop to 12K even lower, before putting it at a bottom. Soloway shares his opinion regarding high inflation rates, the stock market, the crypto market, and the Fed. Before listening to him, please ensure to smash the like button and subscribe to the channel.
My guess is that they'll go to 25 basis point hike after that. And again, I'm looking at the symmetry of what they did, right? When they started raising rates, they started with a 25, they went to 50, then they had 475 hikes, and now they're kind of coming down the mountain on the other side with a 50 and likely 25. And I think by the end of the first quarter of 2023, they're basically not hiking anymore. But the kicker is they're not going to be cutting rates either. And I think that's going to be the shock for the market.
How long do you think the Fed can keep rates high even if they stop raising rates?
So I do think inflation will remain elevated, right?
Yep.
And elevated to me means 3 to 4%, maybe 5%. So again, it's already coming down. We know it's coming down. Oil prices have come down quite a bit. That's helping bring inflation down. But the key is does it go back to 2 or under percent, which is what the Fed wants? And my answer is no. The wage inflation is going to be sticky. Always keep in mind that when people get paid double what they were making, it's not like that business can double the price of an orange the very next day, right? So it has to be passed through over the course of a series of, let's say, years. And so what's going to happen is you're going to see prices incrementally move up year over year to compensate for the hike in wages that we've seen around the globe. And I think that's going to mean that inflation stays north of 3% for at least 2 years.
It's not 2%, it's not 9%. Where are we going to go?
So it is coming down. There's no doubt about it. And you will see a number that reflects that. And part of the issue here is that inflation is from the past year. So 12 months ago, how much has inflation gone up? Well, if we go 12 months ago, inflation numbers were already spiking. So what it's telling us is that, yes, the inflation numbers are still going up. We're still seeing inflation, but the rate of increase is slowing. And that's what we see in these inflation numbers that are coming back in. And I think that's a common misconception. Everyone hears, oh, the inflation numbers were better than expected when they come in, but it's not saying prices are going down. It's just saying they're not rising quite as quickly. So I think investors have to be ready for that. I mean, it means that the prices at the grocery store are still going to be going up over time, just not as quickly. And it's going to hurt the economy. There's no doubt about it that investors and retail Americans in general are going to feel the crunch in 2023. Okay. You have inflation, then the Fed's going to basically push us into a recession that they can't bail us out. And remember, since 2009, the Fed has just been printing us out of every trouble, whether it was, you remember obviously 2009, the collapse in the banking sector, all the bailouts that went on and the quantitative easing that was started. And then that basically continued. Then in 2018, we saw them say, okay, we got to start raising rates. The market through this big hissy fit dropped 20% in a matter of 6 weeks. They actually reversed and started cutting rates again. And then it takes you into COVID, and we know what happened during the COVID crisis with them printing even more money. And that was the massive printing of money that we saw. Yeah. And so it's really everything. It's the inflation numbers, it's the economy that's going to be slowing, and it's also just the overall kind of wear and tear that it does on the consumer.
And I don't see a Lehman-style collapse just yet. People are free to go out and buy homes. We're not in a COVID lockdown. So what's going on?
Yeah, so there's no doubt about it that when you see the 30-year at 7% and home prices are still elevated, very, very elevated, there's not a lot of people that can afford that monthly payment. One of the best indicators of the struggles in the housing market, I got back from Boston 6 weeks ago, and I got into my Uber, and it turned out my Uber driver was a real estate agent, right? Yeah. So that tells you everything you need to know about real estate right now. I don't necessarily see that same sort of 2008 collapse yet, but it is something we have to monitor, and I think you have to expect that if interest rates are going to remain elevated, then home prices probably have 20 to 30% downside from their highs.
And importantly, they said this could bring down consumer spending even more.
Yeah.
Because if you feel like your home is worth less, you feel poorer.
Well, it's the wealth effect, right? It's everything to do with 401ks that when the Fed talks the market down. And remember, the Fed has done that, right? They see the market rallying and they'll say, hey, listen, we're going to be more hawkish, and the market sells off. They don't want the stock market to be up to all-time highs because it creates this wealth effect where people say, hey, look at my 401k. It's worth X amount. I can go buy that new car now. And same thing with home prices. You know, your home, you bought it last year, you already made 100K on it, and it created this wealth effect. So it's all tied into this inflation that's going on. And I do absolutely think that this is one of the things the Fed needed to pop these bubbles. Now, the question is, can the Fed control the collapse? In history, they haven't done a great job of it. I'm doubtful that they can again.
That you don't see the stock markets recovering to its previous all-time highs until several years down the line. We've seen a recent precedent for this, actually. The NASDAQ, following the the dot-com bubble burst in 2001, didn't recover to its previous 2000 level high until 14 years later.
Yep.
Is that going to happen again?
Yeah, I do think it is, and it actually could be worse. So I do think at least a minimum of 10 to 15 years. I want to show you some really cool charts here. So
take a look at the charts.
Here's the Dow Jones Industrial Average, and I'm going to show you guys why I'm showing this chart. So take a look at what we have here. You have this sort of pattern, which is basically this M pattern top in 1915 to looks like right around 1921. All right, and again, you're going to say, well, why the heck is Gareth going back to this period? And then look at the run that the Dow Jones Industrial Average had for the next, basically in the roaring 20s to obviously the Great Depression, the collapse, the crash of 29. And so if you look at that, and now let's just go right to the S&P 500. And this is where it gets crazy, right? So what we can see is that same sort of pattern formation from the dot-com bubble, the dot-com collapse, the real estate bubble, the real estate collapse, and then look at the massive run we've had. Now, a lot of people would say, okay, that's just a chart. It's just, it's a coincidence. But what you have to do is you have to delve deeper. And this is where I love being a student of history. And what you do is you look at what was going on in the early 1900s, 1915, 1920s. And what was happening was cars were becoming more and more the norm. Electricity was becoming more and more the norm. Well, what did that give us? It gave the consumer light at night. They could go out at night. They could go to speakeasies, spend money. They could drive more than, before cars, you were limited to the distance you could go if you wanted to go to the general store, right? And so you had all these things coming into play that created a consumer that could get out there and spend money. Then look at what the lending stuff was in the 20s. There was lending policies that are very similar to a lot of the lending stuff that we're seeing. Now, if we go to the current times in the S&P 500, in the dot-com era, what do we know happened? The internet emerged, right? And the internet basically gave, do you shop on Amazon?
I do.
Well, so do I. And think about that. Now you didn't even have to leave your house to shop and spend money. And so there's these coordinated factors that make me think that we're very similar to what happened in the teens to the 20s leading into into the Great Depression. And I don't want to, it's hard for me not to jump to that conclusion, but I am very concerned that we could see something like that occur.
If it is indeed true, Gareth, that the next 10 years will look rocky and sideways and unfulfilling, shall we say, for the S&P 500, what do? Stay in cash?
No, not necessarily, right? There's always opportunities out there. In fact, bear markets give you one of the best opportunities to buy stocks.
Well, hold on.
Are
you talking
levels.
about a bear market or just flatlining? Because there's a difference here.
No, I think we're actually absolutely in a bear market. In fact, I think 2023 is going to be even worse than 2022 in terms of downside in the stock market. But there are places to go, right? There's gold. Gold, again, great performing asset. It's if you look back and compare the 70s and the early 80s in gold, it's an amazing replication of what we're seeing now. Yet we just haven't started the big move up in gold that should be coming. So there's lots of places to go. And I would say this is that, in general, long-term investors have had their field day since the Fed began bailing the markets out. It's now becoming more of a trader's market where you buy, but then you can't just say, hey, I'm going to tuck this away for 20 years. You want to actually just take the profits and run and then look to rebuy on the next dip.
Okay. Well, how much lower can the S&P 500 get then before we start bottoming and getting this multi-year, if not decade-long consolidation?
Yeah, so I think the S&P 500 has at minimum we're looking at going down probably to, I mean, just in 2023, we will easily see the 3,300 level, which is basically the pre-COVID level. So if you go back to COVID, the February of 2020 period, the S&P 500 was trading around 3,300. We've never retraced back to that level. So it makes full sense that at least we'll go down there. That's about a 15+% drop from here. That's the bear bull case. That's the best case scenario per the charts. Really what we're looking at is likely going a lot lower to potentially a trend line, and I'll show my SPY chart here, but we basically could be retracing in 2023 all the way down to about 3,000. I would say 3,000 or just below 3,000 is my kind of key zone for the S&P in 2023.
Tell us about why you made that call. Why did you think back then in 2021 was everything was going up, everything was hyped, institutional money was going in, you were a contrarian and you thought that Bitcoin was going to drop 70% down to 20K?
Yeah, so it basically was everything you just mentioned, right? It's
Okay.
that in general, as a psychological trader, and part of trading is understanding human emotion and understanding that when the whole crowd, when every single person is rushing into an asset, that's usually the mark of a top. And you saw this, I mean, we saw this in 2007 with the housing market when Time Magazine featured like the flipper, the home flipper on their front page. It's exactly the same thing. I mean, when you have the mom and pop saying, hey, this is so easy, I can't believe how much money I'm making, it's usually the end of the move. And then you look at the charts and you understand the massive move that has gone on, the double top that we saw in Bitcoin, all the factors out there. To me, it was one of those no-brainer scenarios. Plus, let's not forget that by November, when Bitcoin was topping, we knew the Fed was going to start raising rates, right? We already saw inflation spiking, and everyone was saying, oh, like, listen, inflation's spiking, so Bitcoin has to go higher. But the essence of it is inflation spiking. Bitcoin was already factoring that in. Now it had to factor in the major tightening that the Fed was going to bring in. And remember, there was so much money that had been thrown into the Bitcoin market, from checks going to Americans from the government, from quantitative easing, from all the stimulus. People were home. They weren't driving to work, so they were saving on gas money. They weren't taking vacations, so they had extra money. So all that money was going into crypto or stocks. Mm-hmm. Now, all of a sudden, you get to a point where the Fed starts sucking out that liquidity, and there's really no other way for any assets to continue up, and we've seen that here.
That's very interesting to me, how things on the macro picture seem to be getting worse, yet the price is holding steady.
Yeah, so as bearish as I was when we were at 65 to 69,000, I would say I'm lukewarm now on Bitcoin.
Okay.
It doesn't mean I think the bottom is in, but you're right. Let's take a look at the chart of Bitcoin. This is something I want to show you guys.
Yeah.
So here we have, this is the drop on the Terra Luna collapse. And we dropped from about 31,000 and change down to about 17 and change. And so that drop was about 40+%. Now, if you look at the collapse of FTX, Bitcoin only dropped 25%. And so you could argue that FTX was a much bigger blow up in terms of institutional money being involved and kind of the earthquake that it caused, yet Bitcoin dropped less. And so to me, I take that as a signal that says, okay, it's not the end yet, but we're getting there. And so a couple of the analysis points. So number one, I looked at the comparisons of FTX's blow up and the Lehman Brothers collapse in 08, noticing again, Lehman was a bank. It collapsed. An exchange, FTX, kind of like a bank, but in crypto, it collapsed. Now, how long did the S&P 500 take to bottom after Lehman Brothers? And the answer is it took about 6 months. So then extrapolate that out and say, okay, in 6 months from now, we might be seeing the bottom in Bitcoin. And the reason you can kind of extrapolate this out is because human emotion, you could say, oh, well, that's stocks, this is crypto. But the answer is it's all the same. And the reason it's the same is because humans, you and me, we're the buyers and sellers. And does your emotion change? Does my emotion change? No, greed and fear. It's what rules the market. So you can really extrapolate that out. And the last thing I'll say is the S&P, when Lehman collapsed, fell another 45% from that point, from that collapse, before it bottomed in March 09. In that case, we should see Bitcoin fall approximately 45% more from approximately that, breakdown level around 18,000 and change. To me, that gives me a target just below 10,000. And keep in mind that max pain is caused when even numbers are broken. You'll see a ton of stops run at 10,000. That could be the bottom when it breaks into the 9,000.
Just real quick is that psychological?
Yeah.
Okay.
Yes, it's
not
and
a
again the
technical
three factors. Always remember, an investor has three factors to them. Number one is personal discipline. So you have to be a disciplined investor.
Yes.
Number two is human psychology.
Yes.
And that's this part where charts will match up. History repeats generally, or at least rhymes, because of the human emotion and the human psychology. And the last is understanding how to read that through the charts.